All right. Well, good afternoon. Thanks to all for joining us. Welcome to this is the sixth episode of the market update with Mike and Joe from GRB. We're super excited. We got a guest here today. Jim Yockel, the president of the GRAR, is here to join us to talk about the year that was and the year that will be. So we're super psyched that you're here, Jim. Thanks for joining us. But obviously, we put the trouble of Joe having to wear his Bills hat. So we got to talk about the Bills.
No trouble. That means they're still winning.
They're still winning.
Still alive.
Obviously, I mean, Joe, last weekend that was a
nail biter.
That was a nail biter, and
I think you even said you stopped watching the game. Right?
I did. I have been convinced that there are times when it's just best that I remove myself, which I did, and I went skiing and kept my fingers crossed, and they pulled it out. So we, as Bills fans, we get to enjoy at least one more weekend, if not more.
Yeah, it's going to be a challenge.
Yeah, it is. It is. So what time's the game?
3:00 Sunday.
3:00 on Sunday, and then obviously it's great news. Obviously, just to as everyone I'm sure has heard, the just continued progress of Damar, and his health is just continues to get better each day. So we're all just thrilled with all of that. So let's talk about the market. So. Today is January 19th. And some good news is that since the beginning of the year, we have seen a modest decline in rates. I mean, rates have come down. You can actually get a rate below a 30-year fixed rate, below 6%. For those of you that have listened to us, back in, I think it was October, rates peaked above 7%. So we've had a nice decline, and the prognosis for this year is that rates hopefully will end up in the low fives by the end of the year.
I think one important thing is they've steadied, right? I think that was a lot of fear from agents that I spoke with, loan officers, was just give me some steady time. If it's 7, if it's 8, whatever it is, just give me some steady rates.
Right.
And it seems like we've reached that point where we're not seeing those big spikes and that volatility we're seeing earlier on.
Right. And Jim, from your seat, you've been doing this a long time. Historically, a high 5, low 6 rate is pretty low when you look at the past 20 years or so. And from your lens, what else you think we can be doing to educate the realtors, the consumers that rates, although they've gone up, they're still historically low.
It's difficult because the typical first-time home buyer we're talking about, who's worried about rates, when you say, well, back in the 80s, I bought a house for 16%, it doesn't really connect with them. Mm-hmm. That's a century ago. So we've been just talking about the reasons people move matter, and they're usually major life changes. And if you need to move for whatever reason, 1% or 2% probably isn't the worst thing in the world. So we've just been trying to educate people that don't make it about the rate. Mm-hmm. It's about the overall affordability. But if you want a bigger house or a smaller house or a different community, you'll find a way to make it work.
Right. All right. Thanks, Jim. So Joe, I know you always have some great stats to share with our listeners. And one of the things that we like to do is each month is to give all of you just an update on, the business that GRB transacted during the month of December, to give you a sense of, properties, what were they listed for, what did they sell for, what did they appraise for, and Joe, what's the data telling us?
Yeah, so a lot of the same. A lot of what we saw, definitely some pockets that are hotter than others. When we look at the 14615 and 14619 zip codes, those were our hottest markets, and we saw, and the houses in that ranged from 100,000 to 200,000. So right in that first time home buyer price range, right where we're seeing that high demand, and in those areas, they were around 25% over asking was what those houses were going. selling for.
Right.
So, and then some other areas are flat and some were even below asking. So I think there's still that, there's still opportunity out there to get a deal. And I think there's still opportunity out there where if you want that house, you're going to have to be comfortable with going a little bit above asking to get that home. So a lot of the same as what we've been seeing, the month of December, Monroe County and surrounding, we're about 5% over asking. When you throw in Onondaga County and some of the other counties that we factor in, we're about 2% over.
Okay.
So, it's some ups and downs, but I think overall it's just kind of a lot of what the same.
Right.
A lot of the conversations that I've been having with people has been around just a lot of that same. We're starting to see a lot of that aggressiveness over asking. I know there was a home recently with 120 showings and 51 offers that went 125,000 over list. So, we're starting to hear that again, as we heard this a lot last year. I will say overall, the appraisal issues have really subsided now that if we start to see, a big shift in the market up again, we may run into a little bit of that, but the inventory is definitely there. The sales are there to support the new sales now. So,
yeah. And Jim, what we're doing and what we really encourage everyone to do is one, if you're a buyer that got shut out last year, is we got to re-engage these buyers to take a look at, what is their budget today? What can they truly afford? Rates have come down. What's the impact of that? And frankly, there's a lot of programs that I know that GRB has launched and will launch that are really aimed at addressing, some of the payment shock that came with the rates going up. So we're rolling out a temporary buy down product that lets someone kind of have a lower starting payment. Albeit it could go higher and will go higher, but in the event that rates do drop, they certainly could refinance that at a later date. So there's all those options exist, and I think that it's important that everyone just kind of takes a fresh look.
And if I can say, I think that's important to be looking at financing with a little bit of flexibility. What we've heard for the last few years is people who have a grant really have a hard time making use of it because of the crazy market. So anything on the lending side that can add some flexibility is really helpful.
Right. And again, from that perspective, we take, great pride, in being one of the leading home buyer dream lenders in the community. And, that is a grant, but, we typically can close those, Joe, in 30 to 45 days?
Yep. Usually under 30.
Yep. And we're probably going to start to hear more details about that. When, Joe, do you think we'll start to hear more?
So there's some webinars scheduled for early February. Typically the program launches mid to late March.
Right. So if you're listening to this, please reach out to us that if you have a buyer that you think may qualify for that program, let them talk to us. Let's get them prepared so that when the grant program does roll out, they're ready to go. So let's shift gears a bit. So obviously we've invited Jim here. Jim has been a great partner, to the entire real estate community. You've been a lot of knowledge. You have a ton, Jim, and certainly, what we wanted to talk about today was, there's no mystery that the lack of homes for sale has been an ongoing issue for, frankly, for many, many years. And what I wanted you to maybe first kind of speak to is, what is, from your seat, the prognosis for the greater Rochester, upstate New York market in regards to home sales for next year? And then from there, let's begin to talk about some of the broader steps that we can take together to try to address the shortages of inventory that exists.
Sure. I think predicting the future is always difficult, but I don't see anything substantially changing from last year's market to this year's market. And last year, closings were down 11%. That's only going to change if more homes come available for sale. And nobody's telling me any reason to expect anything different than last year. People will sell because they need to, but in terms of adding 100 or 1,000 new homes to the market, I just don't see it, and no one can tell me optimistically where they see that coming from. So I think it's more of the same. The next year is going to be more of the same. What happens with interest rates will have some impact, but I think until we have a significant supply of new homes available, we're just going to kind of be stuck.
Yeah. So I know, so you and I, Jim, have talked about this offline about putting together some type of a local task force to really begin to put together, a plan of attack it's going to take a long time to put into place, but, everything starts with the first step, right? So from your, seat, what does that task force, need to look like, and what do we really need to begin to accomplish so that we can begin to try to make some progress on the shortage that's plagued us for so long?
Yeah, I think where we finally are coming to realize is we've been talking about this for years. Nothing's really changing. And without any action on our part of the industry, the builders, the lending side, the realtor side, we can't just expect somebody to come in and solve it for us. So we know the causes of some of this shortage. The lack of new construction since the recession has been chronic, and it's just not changing. And there's reasons for that. We spoke about it at the economic forecast, but shortage of skilled labor, shortage of land ready to build, and just high costs of materials are really keeping that from filling the gap. And I did some research. Nationally, there may be 6 million homes that were never built that we could have used over the last 10 years. And that's a really big gap to cover. So we're not going to be able to just build a whole bunch of homes and recover that. We have to look more creatively at multiple solutions. So what we're talking about at our board is let's try and have 10 solutions that can add 50 homes to the market of some type. And altogether, that's 500. And then you do that for a bunch of years in a row, and all of a sudden you're making an impact. It's not going to be a short-term fix. So the next step is let's convene the leaders of our industry from the lending side, the new construction side, the for sale side, and let's talk about what the problems are, what the possible solutions may be, and create an action plan that we can then take to public officials, economic development people, nonprofit people, and try and make it a reality over the next 5 to 10 years. This is not going to be a 2023 solution, but if we don't start, it'll never get there.
Yeah. I really can't think of, this is one of the most important things that we need to really address, recognizing that it's going to take, a long time. But Joe, as you and I have, talked about this, one of the, the best ways for generations to build wealth is through real estate. And I think, obviously this is, but if there's nothing for them to buy, then it's, they're going to either continue to rent, stay at home. So I think this is a very, very important initiative that's going to take a long time. And I just want you to know that we here at GRB are on board, want to be involved. We want to be part of the solution and really try to make a difference, long term as well.
Yeah, and I think, as we continue to see rents rise, it becomes harder for renters to save money for those down payments to buy the homes. And then you're in this vicious cycle of, again, just erasing or eradicating that generational wealth because there's no way to get out of that circle.
Yeah. One of the things, Jim, that Joe and I have been doing with our team here is we are kind of beginning to host these events to where we're bringing realtors in from many different companies to really have a chance for people to collaborate and talk about best practices from everything, not only into, what's the best way to present a offer, what should be the appropriate response time, what's the best way to host a brokers event. So we're doing all those things to really try to share and exchange ideas. And I think one of the things that we have to do, even though a lot of us compete against one another, but we got to collaborate because going back to addressing the shortage of homes for sale, that affects everybody regardless of where you work. And I think it's something that we really can't ignore. And I'm excited to work with you and whoever else is going to be on the task force to see what we can do to make a difference.
I think, Jim, one thing you and I have talked about before, and you touched on a little bit on that at the economic forum, was around the issue of investors buying up large blocks of houses. And maybe you can just talk a little bit about that and kind of what some of those numbers you shared were, because that was kind of intriguing.
That's a great point.
It's a little scary. The national average is somewhere between 15 and 25% of homes transacted in 2022 went to corporate-owned, investor-owned businesses with the intention of turning them into single-family rentals. And what concerns me is it doesn't take too many years of 15 to 20% of the sales going to corporate investors to turn them into rentals before we really start going from, we have 13,000 sales this year, minus 10%. All of a sudden you're down below 10,000 sales, and it's already a problem. A couple of years ago, we were at 15,000. So the economic forces that are making that happen are driving more and more people to be forced to rent, which goes right back to the lack of ability to build equity, to build wealth, to continue, doing what you want to do. And there's no change to that in sight that I can see.
And typically when that happens, we don't see those houses coming back into the market.
I think if it goes into corporate ownership, the reason they do it is housing is an appreciating asset for the most part, and they get good cash flow. And that's what they're looking for. So they hang on to them, they rent them. We only see them back when they've come to the point where they're not making the cash flow anymore because they've let the condition deteriorate and they just walk away. And now we have to deal with them as abandoned homes. And then it's a real problem because you can't, in a profitable way, put those back to good use for single family ownership. Costs too much to get it back to living conditions. So it becomes a long-term problem in a lot of ways. But the immediate piece is we as an industry need to figure out a way to help more first-time home buyers, more first-time in their family home buyers get to a position to be able to become owners of some type in housing that can then start them on this track to, bigger homes, different locations, whatever they want to do. But we've got to get that first step. And I think the first or the most common way to do that is to try and give grant money, but that's not helping. It's not changing the situation right now. So we have to be creative. And I think it's exciting to see more people coming together to say, let's solve this as a community and as a real estate industry, because then we'll get some good solutions, we'll get some support, and we'll be able to make some change. It's going to be slow, but a little bit here and a little bit there. And before you know it, we'll look back at 10 years and go, wow, we made a really big change in a lot of people's lives.
Yeah, and I think you touch on it's not even just the first-time home buyer. It's that owner-occupant, right? That customer or that borrower that wants to buy that house to live in it, because if they can buy that house, they're selling their house that they're leaving. And that opens up that house for that first-time home buyer. And I think that oftentimes, these investors come in with these high cash offers. And, as an agent, you're probably trying to do what's best for your seller, saying, hey, here's that cash offer. But maybe we, can take some time to vet out that next offer to determine, is it as strong as cash? Are they pre-approved? Who's the pre-approval letter from, et cetera, because that is just a domino in the whole, landscape of real estate.
And I think that you've seen a lot of that in the industry. Companies, not just banks and lenders, but companies specifically designed to be that bridge to say, we have money, we'll make you, same as cash, and then we'll figure it out later. Because we have to compete with the investor community. They can come in with cash and they can outbid everybody. And then we're going down the wrong path. But I think that we as an industry have the opportunity to start changing that game a little bit.
Yeah. So, well, Jim, Joe, thank you very much for your time today. Jim, thanks, for joining us. We're thrilled that you could take time out of your day to be here. And, obviously we're excited about the Bills game this weekend. I hope when we are back here in a month, we're able to, talk about the Super Bowl, because that'll be about that time, right? Yeah. That's great.
We've got a couple challenging games ahead, though.
That's right.
We got to get through those.
All right. Thanks for listening, and we'll see you in a month.
Go Bills.
Go Bills.